Chapter 9 is about plant assets and intangibles. The learning objectives for this chapter include to measure the cost of a plant asset, account for depreciation, record the disposal of an asset or sale or trade, account for natural resources, account for intangible assets, and describe ethical issues related to plant assets. Plant assets have some special characteristics. For example, you hold them for use in the business, not to sell as inventory. The full cost invested in plant assets can be a challenge to determine because of the difficulty of tracking installation, shipping, and other costs related to the asset. Plant assets usually last several years, and as a result, the recovery of their cost should be allocated over the years they are expected to be used. Plant assets may be sold or traded in. Accounting for the disposal of a plant asset is important because the disposal may create a gain or a loss that must be reported on the income statement. Generally, plant assets can be classified into three main categories. 1. Real estate or tangible assets. This includes assets whose physical characteristics define their utility or usefulness, such as buildings, desks, and equipment. 2 are natural resources. This includes assets that come from the ground and can ultimately be used up. For example, oil, diamonds, and coal are natural resource assets. 3. Intangible assets. This includes assets whose value is not derived from their physicality. For example, software programs on a CD are intangible assets. The physical CD is not the value. The knowledge or the programs on the CD really represent the asset. In this chapter, we will conclude our coverage of assets except for investments. After completing this chapter, you should understand the various plant assets of a business and how to account for them. The first learning objective is to measure the cost of a plant asset. The cost principle directs that you should carry an asset at its historical cost, which is the amount paid for the asset. So, the cost of an asset equals the sum of all costs incurred to bring the asset to its intended purpose, less any discounts. Plant assets include land, buildings, equipment, and furniture. Often plant assets are referred to as property, plant, and equipment. There are several types of plant assets. Common account groupings include land and land improvements, buildings, machinery and equipment, and furniture and fixtures. The cost of land is not depreciated. It includes the following costs paid by the purchaser: the purchase price, the brokerage commission, survey and legal fees, property taxes in arrears, taxes assessed to transfer the ownership or the title on the land, and the cost of clearing the land and removing unwanted buildings. Suppose a company needs property and purchases land for $50,000 with a note payable for the same amount. It also pays cash as follows: $4,000 in property taxes in arrears, $2,000 in transfer taxes, $5,000 to remove an old building, and $1,000 survey fee. With the company's cost of the land would be $50,000 plus $4,000 plus $2,000 plus $5,000 plus $1,000, which equals $62,000. The journal entry would include a debit to land for $62,000, a credit to notes payable for $50,000, and cash would be a credit for $12,000. This entry capitalized the land. Capitalized means that an asset account was debited or increased because the company acquired an asset. The cost of land does not include the following costs: fencing, paving, sprinkler systems, lighting, and signs. These separate plant assets, called land improvements, are subject to depreciation. Suppose a company then pays $20,000 for fences, paving, lighting, landscaping, and signs on August 15th of 2013. The journal entry would include a debit to land improvements for $20,000 and a credit to cash for $20,000. Land and land improvements are two entirely separate assets. Recall that land is not depreciated. However, the cost of land improvements is depreciated over the asset's useful life. The cost of a building includes architecture fees, building permits, contractor charges, payments for material, labor, and overhead. The time to complete a building can be months, even years. If the company constructs its own assets, the cost of the building may include the cost of interest on borrowed money. If it purchases an existing building, its costs include the purchase price plus the cost to repair and renovate the building for its intended use. The cost of machinery and equipment includes its purchase price less any discounts, transportation charges, insurance while in transit, sales and other taxes, purchase commission, installation costs, and the cost of testing the asset before it is used. After the asset is up and running, the company no longer debits insurance, taxes, and maintenance costs to the equipment account. From that point on, insurance, taxes, repairs, and maintenance costs are recorded as expenses. Furniture and fixture includes desks, chairs, file cabinets, display racks, shelving, and so forth. The cost of furniture and fixtures includes the basic costs of each asset, less any discounts, plus all other costs to ready the asset for its intended use. A company may pay a single price for several assets as a group, a basket purchase. For accounting, the company must identify the cost of each asset. The total cost paid, 100%, is divided among the assets according to their relative sales or market values. This is called the relative sales value method. A recent appraisal performed before the purchase indicates the individual land and building market sales value. Use this total to allocate the purchase price using the appraisal ratio. First, figure the ratio of each asset's market value to the total of both assets combined. The total appraised value is $120,000. The purchase price for the land and building is $100,000. The land makes up 25% of the total market value, and the building makes up 75% of the total market value. Land equals 25% times the $120,000 purchase price, or $25,000. Building equals 75% times the $120,000 purchase price, or $75,000. The journal entry to record the purchase includes a debit to land for $25,000, a debit to building for $75,000, and a credit to cash for a total of $100,000. Accountants divide spending made on plant assets into two categories: capital expenditures and expenses. Capital expenditures are debited to an asset account because they increase the asset's capacity or efficiency or extend the asset's useful life. An extraordinary repair, such as rebuilding an engine on a 5-year-old truck or putting a new roof on a 25-year-old building, are also capital expenditures. Expenses incurred to maintain the asset in working order, such as repair or maintenance expense, are not debited to an asset account. Examples include the cost of maintaining equipment, such as repairing the air conditioner on a truck, changing the oil filter, and replacing its tires. These ordinary repairs are debited to repair and maintenance expense. Treating a capital expenditure as an expense, or vice versa, creates an accounting error. This error overstates repair and maintenance expense, understates net income, understates capital, and understates the equipment account on the balance sheet. Short Exercise 9.1 provides an example of how to measure plant asset costs. This chapter lists the costs included for the acquisition of land. First is the purchase price, which is obviously included in the cost of the land. The reasons for including the other costs are not so obvious. For example, removing a building looks more like an expense. State why the costs listed in this chapter are included as part of the cost of land. The other costs, for example, back property taxes, transfer taxes, removing a building, and survey fees, are included as part of the cost of land because they are necessary to get the land ready for its intended use. After the land is ready for use, will these costs be capitalized or expensed? After the land is ready for use, subsequent land-related costs, such as property taxes, ground maintenance, and ordinary land, would be expensed. Rural Tech Support pays $130,000 for a group purchase of land, building, and equipment. At the time of your acquisition, the land has a market value of $70,000, the building $56,000, and the equipment $14,000. Journalize the lump sum purchase of the three assets for a total cost of $130,000. You sign a note payable for this amount. Land, $65,000, building, $52,000, equipment, $13,000, and notes payable, $130,000.